Hey everyone, welcome back to the Mark Loeffler Experience. In this episode, we're going to talk stocks versus real estate. I mean, I get this question all the time. Everybody asks, Mark, should I invest in stocks? Should I invest in real estate? Where should I put my money? Well, the answer is it depends. So we're going to go basically through, pros and cons of each investment. You still have to make the decision for yourself. I can't make that decision for you as much as I'd like to. Yet again, this is something you're gonna have to decide for yourself, and I hope you decide correctly. Here we go. All right. So first off, stock market. I'm gonna talk broad sense here on both sides of the board. So I'm gonna talk broad strokes. I'm going to talk about index funds. If I just bought the S&P 500, and I'll put a little chart here for you, but if I just bought an S&P 500 stock market index, it goes up just under 10% per year, the average stock market return. So that's the average stock market return in the US was 9.2%. With that, the S&P 500 has done slightly better at 13.6. So if you had just bought the index and didn't do anything else, you would have made 13.6% on your return year over year. Obviously, some years are better, some years are worse, yet at the end of the day, you'd be at 13.6%. So if you had contributed $100,000 at the start of 10 years ago and you bought the index, then you would have made your total balance right now would be $357,917.81. So you would have made, basically, your money would be up 250% since then. Obviously, we know that, the rule of 72. So you're with compounding, your money goes up. If every time it hits 72, your money doubles, right? So, your money is doubling just slightly less than 4 years. And I mean, that's pretty good. So benefits of this. Well, benefit is this is set it and forget it. You really don't have to think about anything. You don't have to do anything. You can buy it with a click of a button. You could do it right now. You can go Vanguard index funds and click on it, put $100,000 in, and just forget about it. Walk away and do absolutely nothing. If you did want to, for whatever reason, pull the money out to be buying, whatever, then again, click of a button, you can pull the money out. I mean, this morning I went ahead and took money out of my brokerage account to purchase something or to pay taxes. And it was as simple as go on my computer, 20 minutes later, money was in my other account, so I can go ahead and pay my taxes. So again, super simple, super liquid, 13.6% return, and that's simply buying the index. Now, obviously, guys, I'm not talking about inflation here. I'm not calculating return for after inflation or anything like that. All right, so stocks, right? Like especially you're buying a broad index fund, it's pretty simple, it's super easy, it's super liquid. Obviously you're buying the index fund, you're not really leveraging that, you're buying it straight up. I know obviously we've had people on the show that are leveraging some portfolios and making hundreds of percent return per year. And obviously it's riskier than if you're just buying the index. And they're doing that, and they're basically, I would call it trading for a living. They day traders, yet again, you got a full-time job and you don't want to worry about anything. Buy the index fund, set it, forget it. Now, if you had just, in that scenario, if you had bought the $100,000 and then just added, say, $1,000 a month, right now your end balance is actually almost $600,000. So you would have put $100,000 in, your total contributions would have been $120,000. now your total return would have been $380,000, which is, again, what I talk about is keep adding that little bit every month. Anyways, that's not the whole point here. The whole point is stock market versus real estate. All right, so what are some of the cons of real estate? Well, some of the cons in real estate is it's a lot more active. You can be passive. You can go work with somebody who is the active investor. Yet again, it is somebody needs to be the active investor. You do need a property manager if you're going to hold it long term, or you're going to be the property manager. One of the other things is it is a lot less liquid. If I wanted to go ahead and sell one of my real estate pieces of property, I would have to market it. I would have to, pay some brokerage fees. I would, it would, even if I did sell it, say today, that property may not close for anywhere, 90 to 120 days. I mean, even if I go refinance that property, I'm still 30 to 60 days from start to finish refinancing that property. So it's not like I can get out the cash just like that. And I'm just going to talk to you about a simple real estate deal. So obviously in real estate, we can use leverage, which is one of the greatest ways to do that. So the purchase price, let's say, is $500,000. So obviously $400,000 is our thing. I'm going to calculate for this scenario, there's going to be zero cash flow because that just makes my numbers way easier. And yeah, so you're going to have it's going to be zero cash flow. Everything's going to go. So one of the greatest things, obviously, is that we have amortization, or we have a mortgage and we're paying down that mortgage, or somebody's paying down that mortgage for us, right? So we have zero. So at the end of 10 years, that $400,000 mortgage is now $265,000. So we would have had $135,000 mortgage pay down from that property. So just on mortgage pay down, we would have received 135% return, right? So about half of what we would have got on the stock market, which is, what does that make? That's 6% annually, more than that. Oh crap, it's 13%. It's 13% annually, not compounded. So it's like 8 or 9% compounded. And let's just say that it does rise just above inflation without anything else. So if I had 3% appreciation per year, 10 years, that home would be worth $671,958. So $172,000 gain on the amortization, $265,000, so $135,000. Again, so without doing anything, we're over $300,000. We're about $306,000 appreciate. So $100,000 is turned into $306,000. So just look at it at a straight up basis. I think real estate would give you a little bit higher return than putting dollar for dollar into the stock market. Obviously, it's going to be more work to do the real estate. This is where, for me, it varies. And why did I start investing in real estate? Real estate for me was because it was hands-on, because I could go in and I could change the value of it by adding value to it and by doing different things with it. And then once I got savvy enough, I could actually go in and use other people's money. So now I'm 100% levered, using an investor's money. I do have risk, obviously. If it goes down and we lose money, then I'm on the hook for half of that money too. Yet, obviously with a long-term perspective, I think I'm going to do okay. Yet at the end of the day, I can go ahead and buy real estate without any of my own money and leverage that. And it just affords me those opportunities more than the real estate market. Now, obviously, I'm doing both. I'm diversifying. Yet if you're going to start off, and listen, if you don't want to learn about flipping houses or renovating or adding value to properties, then it's pretty easy and simple to go buy that Vanguard index fund, buy the market, do as Warren Buffett says, do as Tony Robbins says, buy the market, continuously buy that market over time, and you're going to do okay, right? You're going to be just fine, and it's going to be simple, it's going to be easy, there's not going to be any stress. You're not going to, have your retaining wall fall down on you. You're not going to have a rad leak from the third floor into 2 other units and have tenants, doing whatever, right? And this is some of the problems of being a landlord. Yet at the end of the day, I can go ahead and make 100% of my money in a year because I can go ahead and take those risks and use those risks to add value. The other thing is it depends where you are, you can get a deal on real estate. I would tell you I got a deal on probably the second apartment building I ever bought, to the tune of a couple $100,000, because of the way it was marketed and where it was marketed. And you can still go out and do that in the world, depending on where you are and what you're doing. You can get a deal on real estate. The chance that you're going to get a deal on stock, well, you have all these, there's major money, obviously trillions and trillions of dollars out there. If there was a deal on something, they would probably, front load you on it and take that deal away. So, if you're working and looking hard enough in real estate, you can obviously find those deals. Again, saying all of this, you can make a great return on both. There are different options for set it and forget it on both of them. And, I've talked to a whole bunch of people on the channel about, they do or they don't do, like my buddy Ian Zabo, he doesn't do joint ventures so much. And I'm like, you need to do joint ventures. Quinton, who was just on Friday, he wasn't doing joint ventures for the longest period of time. Now he is, especially on larger buildings. And, we all look outside of real estate for how we can add to diversify our portfolio. And again, Kevin O'Leary, I know we just did that video last time with Graham Stephan and Kevin O'Leary. Kevin, if you're back in Toronto anytime, I'd love to have you come on and review my portfolio and go through that. I think that would be the best. I think you should start a series on that, going through YouTubers' portfolios. I think that would be a great series for you and CNBC. Anyways, guys, hope you enjoyed this. Hope this was valuable. Comment down below if you're in the stock market, if you're in real estate, if you're in both, if you're buying index funds, which ones. We'll see you guys in the next one. Have a great one.